So, where is the Toronto real estate market going these days? Sideways. This happens when it seems like nobody can agree on a side. And if you're into chart technicals, you'll know that the sideways pattern is basically a period of consolidation where the two sides fight it out before a breakout happens and a new trend begins to form. The bears think real estate is way overheated. There's no way this is going to last. The bulls think, you think prices are high now? The longer you wait, the worse it'll get. In this video, I'll tell it how it is and give you the major arguments for the real estate bears and the real estate bulls. At the end of the video, we'll let you know which side we're on and why. If you like this content, please take a second to give us a thumbs up. And don't forget to subscribe to our channel so that you don't miss any of this content made specifically for real estate investors in Toronto. Let's talk about the real estate bears first. These are the ones who think the market has gone up way too much and it's simply not sustainable. The news headlines make it sound like it's really crazy, and in some areas it has been, with Durham region going up 37%, Simcoe County going up 41% since last year. If you compare things year on year, remember the prices in March and April of 2020 is right when COVID hit. And right when COVID hit was when the markets took a brief dip because nobody knew what was going on. So year-on-year data will look a lot more dramatic during these couple of months. Either way, the bears think that home buyers are over their heads and are probably just getting by and can only do so because of these all-time low interest rates. They believe that a house is a liability, not an asset, so if anything rocks the boat, we'll see a major loss in household net worth, and that will bring housing prices down. And this is possible. After all, this is what caused the subprime crisis in 2007 and 2008. Then we have some banks calling to cool the market, and I talked about this in another video. Now, not all banks agree with this. TD and Scotia actually think the market is fine, whereas RBC and BMO have been coming out with concrete suggestions on how to cool the market. But more recently, Canada's biggest bank regulator, OSFI, has come out also to say that it thinks the market is overheated, and its main concern is the added financial risk for lenders. So they're proposing to make the stress test stricter, upping the test rate from 4.79% to 5.25% to lower the bank's lending risk. Now, if this goes through, it goes into effect starting June 1st, and the end result of all of this is that it will lower the loan amounts for uninsured bank mortgages, so those who put at least 20% down on their property. Based on my calculations, maximum loan amounts will drop by around 10%, which means people won't be able to bid as high, so home price growth might slow down. The last big bear argument is that super low interest rates and FOMO have pushed forward buyer demand. A housing poll by Scotiabank showed that 39% of Canadians aged 18 to 34 have accelerated home buying plans, and the statistic has doubled in just 6 months. When you combine this with a survey by StatCan from 2020 that shows this age group makes up 50% of first-time home buyers, it's definitely a big contributor to the increase in demand. So if demand is pushed forward, then it's possible that demand will drop in the future to balance things out. Now that you know what the bears think, let's move over to the real estate bulls. We'll start with our favorite argument, inflation. I talk about this a lot, so I'm not going to spend too much time on this, but the Coles Notes version is that Canada keeps printing money to support our weak economy. So the reality is that how much you buy with $1 today just isn't the same as how much it was worth a year ago. There's record levels of federal deficits, so real estate prices need to be higher to justify the drop in value of our money. But there's more to it. Raw material prices aren't just increasing because of inflation. The pandemic has caused so much labor and supply chain problems that have added to the cost as well. Just look at lumber. We've seen over 240% increase in prices year over year. And then we have the big news about the Suez Canal blockage causing supply chain issues, but COVID has actually created a lot more labor restrictions and time restrictions in so many other places as well. A lot of people are buying real estate, a lot of people are renovating, so there's labor shortage as well. All of these continue to push up construction costs and construction time, which bumps up holding costs as well. The end result is that because the costs of building properties have gone up, the cost of selling new construction homes will also go up as well. The bears think demand might drop because of forward buying, and the bulls are saying that demand is actually increasing. Corporates who have been thriving during COVID are taking advantage of low commercial rents to expand. Toronto is Canada's hub for tech talent, so it's naturally a top tech office location choice. Our government is also helping with these initiatives by providing extra funding to Toronto tech companies to help them grow. So Toronto is and continues to be an attractive place to move to, and we'll just keep seeing our population grow. When you have more people, there will be a higher demand for housing. Even if bank regulators think that real estate prices are high, the Government of Canada doesn't seem to think so, especially in big cities like Toronto. So instead of trying to keep prices low, Canada is making it easier for new home buyers in Toronto, Vancouver, and Victoria to get insured mortgages with a lower down payment and a bigger loan sometime this spring. The proposal allows increasing the maximum income of CMHC mortgage borrowers to go from $120,000 to $150,000 and the loan to income ratio from 4 times to 4.5 times. Toronto real estate isn't cheap, so with a $480,000 loan, there aren't many options out there. But once it's up to $675,000, more opportunities do open up, so we should see more people be able to enter the market. So now that you've heard both sides, it's not surprising that we're a Toronto real estate bull, especially if you've watched some of our other videos before. When people say the Toronto real estate market is overheated, it's really not accurate to look at Canada as a whole because the economics in Toronto are so different from other places. And if you look at the numbers, even with the COVID impact, Toronto real estate has only gone up by 10% year on year, which is great, but not as crazy as the news makes it. If you factor in all of the money printing, there should be a good bump in property prices, and 10% doesn't seem unreasonable. The stricter stress tests are from bank regulators, and these only apply to non-CMHC loans, and according to the Canadian Association of Accredited Mortgage Professionals, this is around 49% of all mortgages. The effect of this doesn't stop people from buying, but it might limit buyers from bidding too high. Now, going back to our Scotia survey, 57% of people interviewed believe it is a good time to buy right now, and CMHC loans are actually getting easier to get. So all of this might just mean that higher priced properties might see a temporary slowdown, but starter priced homes won't be affected because demand continues to be strong, and it is in fact growing because of better CMHC loans. I'd have to say that the bear arguments are at best short term, whether it's stricter stress tests or even raising interest rates. These are intentional actions trying to push things down when natural forces are trending up. Recently, we hear MP Adam Vaughan, who is in charge of housing policy in Canada, come out to say that he feels that real estate price drops will be hard on homeowners. So based on this, the government probably won't be putting that much downward pressure in real estate, which means that the possibility of government intervention just became weaker. The more important thing is that real estate prices are naturally getting more expensive because money is losing value and there continues to be real growing demand for housing in Toronto, and these are strong upside forces that won't go away. We've always been bullish on Toronto real estate, and we continue to maintain our stance for lasting, long-term real estate growth in Toronto. Here at Elevate Realty, we specialize in helping investors get into the Toronto real estate market. We're a full-service brokerage. We analyze the best opportunities for you, help you buy, lease out, and can even manage your properties for you. If you do want to learn more about us, head over to the link below to connect. Don't forget to give this video a thumbs up, and if you want to get more frequent updates about real estate investing in Toronto, look for us on Facebook, Instagram, or LinkedIn. I wish you all the best in your real estate investing journey. Thanks so much for watching, and I'll see you in the next video. Bye.